An income statement, also known as profit and loss statement, it is one of the most critical financial documents for any business. It is like a motion picture. It shows the financial performance of a company over a specific period, whether that is a month, a quarter, or a full year. At its absolute core, the income statement answers one fundamental question: is the business actually making money from its core operations? To truly understand how it works, and what it is used for, um, we need to break it down into its main sections, which is revenues, cost of goods sold, operating expenses, and finally net income. We read this statement from top to bottom, which is why we will often hear professionals use the term top line and bottom line. It begins at the very top with revenue or sales. This top line represents the total amount of money brought in by selling goods or services during that specific period, before any costs whatsoever are taken out. However, generating revenue does not automatically mean a company is successful if its costs are too high. That brings us to the second section, the cost of goods sold. These are the direct variable cost explicitly tied to producing the goods or services a company sells. For example, the raw materials and the direct labor required for manufacturing a product. When we subtract the cost of goods sold from our total revenue, we get our gross profit. This is a crucial metric because it tells us how efficiently a company is producing its core product or delivering its service. But a business has many more expenses than just basic manufacturing. We must also deduct operating expenses. This is where deep understanding of general cost and corporate budgets becomes essential. Operating expenses include the fixed costs that keep the business running regardless of the daily sales volume. Things like administrative payroll, office rent, marketing campaigns, and software subscriptions. Distinguishing between the direct variable cost and fixed operating expenses is incredibly important. Knowing exactly how these costs behave is what allows us to calculate metrics like the break even point, the exact moment where total revenues perfectly equal total cost. Once we subtract all of these operating expenses from the gross profit, we arrive at the operating income, which shows us how the profit made strictly from standard business operations before dealing with government or the banks. Finally, we must account for those external financial factors. We subtract interest expenses from loans, and we subtract taxes. After all of these costs and expenses have been meticulously deducted from the initial revenue, we arrive at the bottom line, the net income, or in some cases, the net loss. This final number is the ultimate measure of a company's profitability for that period.